You may or may not know this, but the first $15,000 of gifts you make in any given year may be excluded from the gift tax. However, this doesn't apply to all gifts. There may be a catch, and this episode is all about determining what that catch might be. I'm Griffin Bridgers, and this is 10 Minutes with Griffin. For today's episode, episode 167, we're going to dig into the gift tax annual exclusion, which excludes a certain amount of your gifts every year, up to a certain dollar amount, but has some other requirements that must first be met. Now, as always, this presentation is not intended to substitute for legal or tax advice and is provided for educational purposes only. And if you'd like a copy of these slides, please email me at griffin.bridgers@gmail.com. So, why is there a gift tax annual exclusion? Well, the gift tax generally applies to any gifts that are made by an individual, known as the donor, during the year to another individual, known as the donee. So, both of those are determined on a year-over-year calendar year basis. Now, the gift tax calculation is cumulative, but we're going to put that to the side for another episode for the time being. Now, can you imagine what the IRS reporting requirements would be if you had to report every single gift you make during the year? It would be a nightmare for both you and for the IRS. So, customary gifts that are really based on the relationship or occasion and not based on the intent to transfer wealth aren't captured by the gift tax. So if you make a birthday gift, a holiday gift, a wedding gift, whatever, that's not going to be reportable. Instead, what the IRS does is it creates an annual exclusion so that those gifts you make during the year under that dollar amount aren't subject to gift tax reporting or gift tax payment. So, in other words, a better way to think of this is that the annual exclusion looks to the intent, and it reflects that only large and intentional transfers of wealth could be subject to gift tax reporting and gift tax payment. So, what is the annual exclusion, and how does it work? Well, what the gift tax annual exclusion does is it excludes the first $15,000 in certain types of gifts to any one donee in any given year from the gift tax. Recall that the donee is the recipient of a gift, whereas the donor is the transfer or maker of a gift. Now, in order to qualify, the biggest caveat here that's most often missed is that the gift must be a gift of a present interest. Now that's confusing to the non-attorney, so we'll look at that on the next slide. But it's also important to remember that this isn't a blanket exclusion for all your gifts you make during the year. This is only considered by individual donee. So the donor doesn't have one annual exclusion. Instead, it's a per donee annual exclusion, and it's not dependent on any form of relationship between donor and donee. So, for example, let's say you have a very generous donor who goes around writing $15,000 checks to random people on the street. And after writing 1,000 of these checks, the donor is drained their estate and no longer has money to give away. Now, since none of those gifts exceeded that annual exclusion of $15,000, the donor has no gift tax payment and has no gift tax reporting obligation. So, pretty neat. It's by donee and not by donor. So if you can find enough donees, you can really leverage this to reduce the value of your estate to save estate taxes down the road. Now, the amount here of $15,000 is indexed for inflation based on a base of $10,000, but it only goes up in increments of $1,000. So in the next year or two, we should be seeing an increase to $16,000 per donee, especially because really the inflation adjustment for 2021 was $15,900, which didn't quite hit that $1,000 increment, but this shows that we should be seeing an adjustment in 2022 or 2023. So what is a present interest? Well, this is a foreign concept to the non-attorney who hasn't studied property law. Now, you only really concern yourself with this in a situation where you're not making a direct gift to somebody. Instead, you're only going to see this pop up when you have, for example, a gift in a trust, or a gift of a remainder interest in property, such as with a life estate. We're not going to really focus on life estates today just because that's a a discussion that warrants its own separate topic in and of itself. But for the sake of simplicity, what we're going to do here is focus just on trusts themselves, because that's a pretty common gifting vehicle you might see. And what this is going to apply to is really an irrevocable trust, and I wasn't clear about that in the slide. But when you look at trusts, in order for a beneficiary who's an indirect recipient of that gift to have a present interest, then that beneficiary has to have the immediate right after the gift is completed to benefit from the property. So that benefit word is the key term. Is there an immediate right to benefit? So a benefit generally will include the right to do any of the following: either receive all the income of the property, use the property, or withdraw the beneficiary's share of that gifted property, which is commonly known as a crummy power. We'll discuss that in a later episode. Now, present interests in some forms are automatically granted, even though the gift in form is a future interest gift. So there are certain types of transfers, especially to minors, that will qualify for the gift tax annual exclusion. Those include a transfer to a 2503C minors trust, which is for one beneficiary under the age of 21. It also includes transfers to custodial accounts like UGMA or UTMA accounts, and it could apply to a transfer to a 529 account. And in addition to that, if you go back to my episode 68, you'll see a discussion on how you can superfund a 529 account with up to 5 times the annual exclusion. Now, for anything that's not a present interest, you have a gift of a future interest. Now, for a gift of a future interest, there is no gift tax annual exclusion. So that means every single dollar of that transfer will be subject to gift tax reporting. So what that does is it reflects the intent that the gift tax will apply to intentional wealth transfers, as I mentioned earlier. And typically, a gift of a future interest is going to be an intentional transfer of wealth. You only really create that to save transfer taxes in certain forms or fashions. Now, a future interest is anything that's not a present interest. So that would include things like most discretionary income interests in a trust without a crummy withdrawal right, and would also include remainder interests in trusts or life estates. Now, one thing I didn't mention in the slides is that depending on the form of trust, you could have a gift that is both a present interest and a future interest, and in that case, you can split up the value that you're gifting there between the present interest and the future interest to determine the present value of those two things based on time value of money principles. If you're interested in looking more at that, I have a long series, I think up to 7 parts now, on estate planning calculations that digs into the actuarial tables and methodology that the IRS uses to determine the value of future interests or present interests for gift tax purposes. Now, if you have any gifts in excess of the annual exclusion, for example, a gift to any one donee exceeding that amount, or any gift of a future interest, then in either case you have to file a gift tax return for that year by April 15th of the following year, subject to extensions. Now, gifts in excess of the annual exclusion and in excess of deductions, for example, if you have a transfer to a spouse, are known as taxable gifts. So the taxable gift concept is important in a couple ways. One, your gift tax is calculated only on your taxable gifts, and that gift tax is offset by the applicable credit, which is equal to the gift tax that would be payable on a taxable gift in the amount of the applicable exclusion, which is currently $11.7 million. Also, when it comes to the calculation of the estate tax, taxable gifts are also reported on the estate tax return at date of gift reported value, unless they're included in the gross estate, in which you remove them from that taxable gifts bucket and put them into the gross estate. And in that case, you'd use date of death, fair market value, or the fair market value on the alternate valuation date. And that's a discussion for another time. Now, a few other tidbits. There's also a generation skipping transfer tax annual exclusion of equal amount, but it's a bit more limited than the gift tax annual exclusion for various reasons. Now, you'd only be worried about that with a gift to a skip person, but the limitation here primarily comes when we look at crummy rights, and that's another subject to come in a later episode. It's also important to consider, too, that if a married couple wants to make a gift, typically they're making a gift as one economic unit. Now, in order to avoid having them both write a $15,000 check to combine their gift tax annual exclusions, they can file one gift tax return and make a gift splitting election. Now, it's not a joint gift tax return, it's really just a gift splitting election, which we'll talk about in a later episode as well. Then finally, if your gift is less than the annual exclusion, then your annual exclusion is limited to the gift amount. So you can't create a negative gift or artificial gift tax refund. So for example, if you had a donor who gifted $12,000 to the donee during the year, and it's a present interest gift, then the donor could only subtract $12,000. They couldn't subtract the full $15,000 against that lesser gift to generate a negative $3,000 gift tax attribute to be carried over in the form of a credit or deduction or anything like that. You don't get that benefit. So lots of nuance to the annual exclusion and lots of ways that grows its tentacles out into the gift tax in terms of subsequent discussions, but it's still important to understand how that works in the legal and tax context. As always, if you have questions or topic suggestions, you can email those to me at griffin.bridgers@gmail.com. But thank you for listening to this episode of 10 Minutes with Griffin, and I look forward to seeing you in the next one.